Good evening, everybody. Welcome to Trading the US Markets. It's being presented by FP Markets and Adam Grimes of Waverly Advisors, who's been kind enough to do a live session from us in the early hours of New York. Just introducing Adam at Waverly, and I guess as a result of our direct market access model, we're always looking at ways to enhance our traders and investors' experience. We feel that Waverly Advisors has some great research offering very good insights and tradable ideas every week in their research pack. It covers the US market specifically and touches on the futures markets as well. If you don't know Adam already, he's got over 20 years experience in the industry as a trader, analyst and system developer. He was Vice President of Quantitative System Development at Level Partners LLC. He was also a senior analyst and trader at MBF Asset Management on the New York Mercantile Exchange, and he was the chief technical strategist at SMB Capital. He's also the author of The Art and Science of Technical Analysis, Market Structure, Price Action, and Trading Strategies. As I said before, we're very lucky to have him with us live from New York. We do have a special offer this evening for anybody who funds an account with 1,000 Australian dollars or equivalent over the next 7 days, or for any of our existing clients who haven't traded the US equity CFD markets with FP Markets. Those of you that do the above will receive 1 month of the Waverly Advisors Tactical Playbook. You'll also receive 400 Aussie dollars in US markets brokerage. And you will have access to free data feeds to all of our international markets, 20 minutes delayed, including the US. Popping into the webinar and why we're here tonight, we simply can't ignore the performance of the largest equity markets in the world. The US market makes up 50% of global markets. And as you can see, the performance to last Friday, I've outlined the ASX 200, the S&P 500, and the NASDAQ as well. So the 10-year performance for the Aussie markets is 14% or 1.4% per year over that 10-year time frame. When we compare that to the S&P was up over 58%, and the NASDAQ was up over 120%. So looking at that from a year-by-year basis, the S&P was up around about 6% every year for the 10 years, with the NASDAQ being up 12% every year for the past 10 years. And look, I think it's also important that when we look at markets more recently, we do have to look at what has happened to markets as they've been selling off. And once again, we've had outperformance with the US markets. The ASX markets were down 8.6%. The S&P 500 has done better than that, albeit with a negative return of minus 2.1%, which is an outperformance of around about 5.5%. And sorry, I should say 6.5%. And then the NASDAQ is up 4.4% over the same time frame. So there certainly are good opportunities in overseas markets, especially the biggest market or the biggest equity market in the world, being the US market. Our US offerings, and a lot of people in the Australian market do only trade the Australian share market, but we're letting clients know that we have offered the US markets for some time. We have over 4,000 US equity CFDs on the long side. And in terms of shorting ability, we can short nearly 2,000 US equity CFDs. This is far greater than any of our competitors out in the market. In terms of brokerage, it starts from US $15 or 2 cents per share. And a lot of people like the fact that they can call the dealing desk here at FP Markets for no extra cost to place the phone orders. In these US offerings, this does include ETFs for those of you who want to trade the ETFs, any of the iShares and Pro shares as well. And remember that you can do both the ASX, the US markets, UK, Asia and futures markets under the one single platform that we offer here at FP Markets. We use the IRESS investor and IRESSTrader platform, and we do have a free platform which is using a click to refresh system, so that anytime you need a snapshot of the market live from the exchange, you can just click a button to get that data to you. And that can be a good way to work around having to actually pay for a live data feed and platform. Many of us, myself included, tend to use contingent orders which can be placed on the IRESS platform. And this, of course, can avoid any late nights. A lot of people have this idea that to trade the US markets, you need to be staying up all night and viewing them. But there are many people who do position trading, trend trading, swing trading, anywhere from a few days to a few weeks, and even those who hold for many months. Can set contingent orders in the market with their buy or sell orders and with their stop losses sitting in there as well, without having to actually watch the markets live. They can then go in and make any adjustments if their triggers are hit, or make any adjustments to their working orders sitting in the market. And finally, I think it's important to note that there are other providers out there who may offer the US markets, but as they offer them through brokerage firms in the US, the ownership does lie with the broker over in the United States. This is where we are different. You do have ownership of the CFD with an Australian company, which means that you do fall under the laws of ASIC and the regulations which are governed here in Australia, and not running into trouble with regulatory issues overseas. I guess finally, just to finish up before I hand over to Adam, FP Markets does offer direct market access CFDs. Now, these are suitable for both long-term investors who only invest in shares or equities normally, and they also, very useful for active traders as well. I think people need to remember, including the long-term investors, that direct market access CFDs still do pay dividends. And in terms of the cost of these, they are generally 50% cheaper than, I guess, comparisons to CommSec, E-Trade, Westpac and NAB, any of the big four. So people often do come across and use them to get that 50% reduction in commissions. For those of you who understand that CFDs are a leveraged product, because we are direct market access, we offer a non-leveraged CFD, which can often be a stepping stone between people using direct equities and making the move to leveraged CFDs. The non-leveraged CFD product tends to be a good halfway house in terms of accessing the cheaper commission rates, and as I say in the next point, to make money in rising or falling markets. So there's a lot more opportunity to make money on the short side with leveraged or non-leveraged CFDs. The final few points is, of course, hedging. If people do use our platform side by side with somebody like CommSec and they are holding positions that they don't want to sell, then they can hedge the position out through FP Markets by placing a short in the market. It does replace options. For many people, options have become very expensive. And for those of you that prefer to pay $10 versus $35 and above, remember that our leveraged CFDs have no expiry. There is no time decay. You have access to leverage, and as with the call and the puts, you have both long and short with our CFD. So these can be, I guess, a really good alternative to replacing what is quite an expensive product in terms of options. And finally, you can use unrealized profits with CFDs as margin to open new positions. So if you are sitting in handsome profits and there are other positions you are looking to open, then you can certainly go ahead and do this with those profits. I guess moving to why we're here tonight is to hand over and listen to Adam Grimes. He's the Chief Investment Officer at Waverly Advisors, and they put out a research pack every Monday with daily updates with tradable ideas, as well as helping to bring down the universe of US stocks, which people will be looking at. So I'd like to thank Adam for taking the time in the early hours of the morning over in New York, and I'll hand over to Adam now.
Great. Can you hear me, Ashton? I'm not sure if my audio is connected. I think I am. Before I get rolling here, if you could give me some feedback in the chat. Are you able to hear me? Thank you. Fantastic. Okay. Then thank you, Damon. So let me fast forward through here. So first of all, thank you. All of you, happy to have some time to talk about some market concepts, and I especially want to thank Ashton and FP Markets for the opportunity to connect with you. And some of you have seen my work and have heard me speak, have read my work. If you haven't, then I guess I would encourage you to just Google me, Google Adam Grimes Trader, and you will certainly find a wealth of information. I will give you some material at the end of the presentation that will point you in the right direction. So I'm going to talk a little bit about my philosophy, if you will, my way of looking at markets, where I have found an edge, and I'm also going to talk about Waverly Advisors and the research I write there and how we are able to package that edge and communicate that edge to our clients. So this is, I'm up at 5 o'clock in the morning New York time, and part of that is because I am a fanatical nut that barely sleeps, and I watch all of the markets. I watch Europe when it opens, but the real reason I'm up is to talk to you today about this, because this is a topic that really is important. So kind of some high-level stuff. What's a trading edge? Well, there's a lot of misinformation out there, and there are a lot of misleading marketing things. And I think it's very easy to find things that focus on high probability trading. You also hear people talk about low-risk trades. Both of those are wrong. Both of those ideas hide the truth. The truth is the only way to make money is over a large set of trades for you to have a positive expectancy. And that expected value is basically your win percentage times your average win minus your average loss times the percentage of times you lose, and there may be break-evens in there, which pretty much zero out. There are frictions, commissions, and everything, but that's the concept. There are basically two ways this can work. You can be right more than you're wrong, but in that case, your average loss will probably be larger than your average win. So if you're a high probability trader, you're probably going to have larger losses than you do wins. There are also many trend following systems that have very low win ratios, under 30% sometimes, and people have difficulty handling that and trading that. However, these systems can be fantastically profitable. We published one in our research which caught all of the major trends in currencies, and when these systems work, the winning trades are many, many, many times the average losing trade, 20 times in some cases. So that's the basic concept, is we need to have a trading edge that gives us a positive expectancy. So where do we find the trading edge? Well, people look in a lot of places: fundamental, macro, technical, quantitative. People read the news, people have opinions, people use the moon cycle, people do all kinds of things to find an edge. Many things have some value. But again, I don't want to be too negative here, but I want to point out some of the things that I have seen, some of the paths that I've seen people go down, and it turns out to be not constructive. Things like focusing exclusively on psychology. There are a lot of trading psychologists, and truthfully, trading is difficult. Trading requires the proper mindset, the proper psychological tools, but in many cases, my experience has been the solution to psychological problems is to trade with an edge, to do something that works. Most people, most market participants lose money. Probably the biggest, no doubt, the biggest reason is because they're simply doing something that doesn't work. Naive use of fundamentals. There are good ways to use fundamentals, but if you're reading the news and kind of trying to figure it out each day and thinking where markets are going to go based on your read of the fundamentals, that's probably not a way to build an enduring professional trading strategy. Opinion. We all have opinions, and the market doesn't care. We can't trade off of our opinions. So there are a lot of things. The last thing on this slide says technicals that don't work. So when I tell you a little bit more about Waverly Advisors, Ashton introduced me as a discretionary trader. That's half true. I actually would label myself as a blended discretionary and quantitative trader. Many people would look at what I do and would say, you're a technician, you use technical analysis. But we have a problem with that because most of the things that traditional technical analysis teaches simply do not work. They don't pass quantitative tests. And if you, we could spend hours going into this. I gave a 3.5-hour talk on just one aspect of this about a year ago. So we don't have time to cover everything. I'm going to do a lot of hand waving today and say, trust me, but I don't want you to trust me. I want to encourage you to think critically, to do the work yourself, and probably a good departure point is my blog, where I've written a lot of, and it's out, everything's out there for free. You can really dig into some of these things, but I'll show you one example today, and we'll kind of touch on the others. Just be aware that many people, for instance, you're trading off of levels. A lot of people like to trade off of levels, and whether these are projections for each day or they're moving averages or there's some level derived from a chart pattern, just be aware that any line you draw on a chart is going to look significant. You can't trust your perception. You have to do a little bit of analysis, and that analysis has to be done properly. And when you do that, I have been, after extensive work, unable to verify that there are any actual support and resistance levels that have statistical significance in the market. And it's just one example of the kinds of things that fly in the face of conventional wisdom from technical analysis. So when we think about evaluating an edge, and when I tell you something doesn't work, this is how I'm looking at it. Any trading methodology, anything we say or think about a trading methodology, an approach to the markets, trading system, whatever, is only valid over a pretty large sample size. On any one trade, anything can happen. You all know it's very possible, open an account, make a trade, and make 10 times your money on that one trade. I would gently suggest if you're a new trader and that's your first trade, that's the worst possible thing that can happen to you, to have that kind of early success. But you can have somebody do everything wrong and make a lot of money. You can also have somebody, of course, do everything right and have a string of losing trades. This makes learning very difficult, and this is where I think a lot of the psychological tensions and problems come from. It's kind of this random reinforcement from the market. So the only way we can drill through that is to do some statistical analysis. And this is not a presentation on that word's difficult to say at 5 o'clock in the morning. Give me a break. This is not a presentation on statistical analysis, but I just want to give you a little bit of the sense of the work we've done and the work that supports my perspective on markets. This is certainly not the only way to look at markets. It is, in my experience, and I've been down pretty much every dark alley in the possible trading universe. This is the methodology and the approach that makes the most sense for me. It's where I found the strongest edge. It's not the only way. I'm not presuming it's the only way. Let's go into an example. I want to look at moving average trend indicators. You know, when we look at moving averages, these are the kinds of questions we would ask. There are many different kinds of moving averages. Simple, exponential are probably the most common. There are a lot of others. There's center, they're triangular. There are a lot of different ways to calculate exponential moving averages. There are moving averages that adapt to cycles, all these different ways to do it. And traders use them in different ways. Support and resistance is a trend indicator. That's what we're going to look at here. People execute off of moving averages. And so this is great, but how do we know if it really works? You can't just put it on a chart and say, does it work? Because your eye is going to tell you it does. So the questions we actually ask is there non-random price action around moving averages? So we have to define this, but basically what I'm asking is when price comes down and touches a moving average or goes through a moving average or does something around a moving average, does what happens after that event look different than all of the other market action? So let's just use an example where price comes down to a moving average. If I look what happens every time price touches a moving average, and then I look at 5 days, 10 days, a month, 6 months. I don't know what the right time frame is, so I'm going to look at every time frame after. And I collect all of those events where price across a large number of markets touched a moving average. And then I have two categories of market action. I have the ones that we have just defined as being the signal, where prices touch the moving average, what happens after that. And then I have other trading days, any other trading day. And if a moving average has some significance in price, those days will look different. They have to. And here, this is where we run into a lot of arguments with technicians who've been through these training programs that teach them things from books that are completely untested and unverified, in many cases untestable, and they'll just say, it's an art. And I wrote a book called The Art and Science of Technical Analysis. I'm very aware there is an art to it. There's also a science to it. And one of the things that if you get nothing else out of the 10 minutes I've rambled so far, I guess what I would like you to get is this. You cannot have something that is significant in the market and is also invisible in the data. If a moving average moves prices, if moving averages provide support, if Fibonacci ratios provide support, then it whatever. If they're significant, then it has to show up in the data. And if it doesn't, and if we run these tests over and over and we don't see it in the data, then the presumption starts to become maybe these things don't work. And the weight of evidence actually should be on the people that says they do. To drill down just a little bit deeper, let's look at moving averages as trend indicators. And a lot of people do this. This is, if you've done much reading or research on technical analysis, you know this is a common technique. We're given some indicator that signals a trend, and we're told to buy or certainly to avoid shorts when the trend is up. You heard that before? Of course you've heard that before. Only look to short when the trend is down. And there are various ways to do that. One of the kind of smart marketing things that a lot of people have done is to say, look at different time frames. And you're only going to trade your time frame when the higher time frame trend is up. Only then can you buy your time frame. I think that smart gets us a little bit harder to test, but guess what? We can do it. This is easy to test. What we can do is take these trend indicators and categorize returns by the previous bar's trend condition. Now, we have to go previous bar instead of today's because coming into today, let's say the market went down very strongly today, and I'm saying the market. This can be anything: currency, commodity, option, stock index, individual share, whatever. If the market declines today, that will flip the trend indicator to bearish. But that actually happened on the close of the day. We came into today with a neutral or bullish indicator, and so you have to be careful how you categorize that. Make one small mistake like that and you completely skew the results. So here on your screen, just the dollar index, not a great market, but it's good for it's good for discussion here, with a 50-period simple moving average. And one of the simplest ways to do a trend indicator is to say when the average slopes down, the trend is down. When it slopes up, the trend is up. You've all heard that, you've all seen that, and I've marked with arrows here the trend inflections where the moving average turns. Now, here's a kind of complicated table, and I may have some kind of pointer here. Let me see. I believe I do. Okay, so let's look at the equities column. This is a rather large sample of U.S. stocks, and no matter how you slice this different time periods, you see something similar. What I would like you to look at, so this table's divided into 3 big rows, big sections. Down, so a downtrend condition, here's the uptrend condition, and here's all days, but both of them mixed together. This is very interesting. This is the mean excess return in basis points. When the trend indicator is down, the market's more likely to go up. Now, take a moment and kind of wrap your head around that. Think about that. When the trend indicator is down, the market's more likely to go up. And we see the same thing when the trend indicator is up, the market is more likely to decline. And this is a function of mean reversion in equities. If we jump over and look at futures, we see a very small but negative effect for a downtrend indicator and a very small but positive for the uptrend indicator, and currencies are pretty close to zero. Now, this is just one test. This is one of literally thousands of tests that I use, that I've run, that I have done to understand markets better. And this also challenges one of the other beliefs of technical analysis, which is all markets trade the same. Have you heard that? You can apply any tool to any market and it will work just the same. In many cases, that claim is true because the tool doesn't work at all, but that's not what they're trying to say. And I believe I have to get out of this tool to be able to flip. Let's look at a different one. So this is the classic triple moving average trend indicator. This uses the 10, 20, and 50, and we have an uptrend when they're in the right order. Fast is above, medium is above slow, and that flips. Many of you have seen this, and I just want to point out, I don't really want to belabor the point here, but you see the same effect. So this is probably one of the most commonly accepted and used tools of technical analysis. If you use this tool, particularly with stocks, and it is emphasized strongly by stock traders, you are actually trading with a statistical headwind on every trade you make. Before you begin, you stack the deck against yourself. So this is an isolated example. Like I said, if you want to see more of this kind of work, and if you want to trade using technical tools, you should want to see more of this work, go to my blog. I'll tell you how to get there at the end of the presentation. I'm going to skip over this slide, and I don't want to be really negative here. You know, I can spend hours talking about what doesn't work. What does work? Well, I'm going to show you a very simple analytical framework that I use, that I've developed, which is simply based on the idea of 2 competing forces in markets, mean reversion and momentum. So mean reversion is the tendency of a large spike in a market to be reversed. Many of us, when we begin trading, have the experience of a market goes up, we rush to buy, and what happens? The market immediately sells off. Some of us, I did, some of us do this several times before we begin to figure out maybe this is not the best idea. That's mean reversion. It's a strong force. Another force, though, is momentum. Momentum is a key force in a lot of investment models. There are a lot of factor models. Momentum is the tendency for a market to make a big move and to continue to make a move in the same direction. Now, I think what happens with this is that a lot of times these forces are in balance. When they're in balance, we can't really say anything about the market. The market is a random walk. All those random walk, efficient market people, and it's not the same thing, but all those people that talk about random price movements are usually right, and they're right when these forces are in balance. But we've been able to identify some patterns. And these give motivation for trades. These give specific trade setups. These give specific entry points. We've been able to identify some patterns that show when one of these forces is more likely to prevail in the future. Now, that's not exciting. I mean, it is exciting, but it doesn't sound exciting. It doesn't stand up to a lot of the marketing hype that's out there, but this is the reality. This is how you build an enduring trading edge. Markets are very competitive. It's very hard to make money. The only edge that's out there is a small edge. There's no, win 90% and have your winners be 3 times the size of your losers. That doesn't happen. That doesn't exist. It's not possible in competitive markets. But if we're able to identify these points where we're likely to say, over the future, and we can define the time period, a big move is likely to continue, then that tells us how we should trade the market. If we can say any big move is likely to reverse, that tells us something. And we can look at these pieces interlocking on different time frames and start to build an understanding of how the market is behaving. And these tools are not a secret. I've written about these in many, many places. In my book, I have a trading course, a free trading course. There's no upsell, there's no premium area. It's about 30 hours of video, and it's about to become many more hours of some of the best trading education that I'm aware of that discusses these patterns and how to use them. So, it's out there. But some of the tools would be for mean reversion. We might look to fade large single bars, and you have a large bar we'd have to measure on a volatility adjusted basis. Fading in-day runs, and plug in your favorite number. So we could be looking to fade markets. Fade means to go against a market that has moved 3 days or 5 days or 10 days in the same direction. We can also look to fade breakouts of in-day highs or lows. Another thing stock traders like to do is to trade stocks at 52-week highs. Well, there's a tremendous statistical edge for stocks at 52-week highs to reverse and sell off. So again, that's a very common technical tool, but if you're using it, you're on the wrong side of the market already. Rather, the edge, particularly in stocks, is to look to fade breakouts. And I will also tell you, I keep coming back to stocks. Waverly Advisors publishes on all asset classes. Our primary focus, though, is the U.S. equities market. So that's kind of our bread and butter, and it's where the bulk of our analytical work is. And as I said, some of these tools do need to be adapted to work in different markets. So we don't necessarily look at mean reversion and currencies the same way we do in stocks. And then momentum, volatility compression, which is something we're seeing in major indexes now. If you look at, and you can see this just as a triangle on daily charts, there's a series of inside days, ranges becoming very small relative to the longer term range of the market. This shows that when the market coils like that, any breakout is likely to see some continuation. Pullbacks, different ways to structure it. Here is an example. If you look at your screen, I like to use Keltner channels. There are certainly other channels and tools that work, but what I'm showing here is a number of short entries based on a very simple system that takes a short trade when the market trades outside the Keltner channel. It enters short at the moving average. I would not advise trading the strategy as is. However, if you did, and I'll tell you, when I give these heavy-duty presentations, this slide comes after many, many, many slides of things that don't work. So it's always a bit of a relief, but I'll tell you how to read this very quickly. It divides into column sections, so you have equities, stocks here, futures, currencies. The buy signal is on top. The sell signal is on bottom. And you can watch this on replay and pause and dig into it a little bit deeper. The column that really matters for us is there are two. There's the win percentage in this case. So this is showing that one day after we got that buy signal, the market was up 57% of the time. And it was up an average, and all these numbers are basis points for the returns, 50 basis points. Folks, that's very significant. That's a tremendous edge, and we see it a week out. You know, 50, you're up 58% of the time, and we see it a month out, and you know, this is a small window. We look at other time windows. And for the sells, you know, for the sells, we would like the excess returns to be negative, and they are in fact here. With some shorting stocks is a little bit more difficult systematically than buying stocks, but this is still a very solid return with a solid win ratio. Futures, you can look at these numbers. I'll walk you through very quickly. Positive returns, win ratios were up above 50%. Good negative returns for the shorts. Win ratio, we're down. You're down 40% of the time, and these are not small samples. The sample sizes aren't here, but these are hundreds, thousands of trades, tens of thousands in some cases, and you know, similar effect in currencies. Actually, currencies, you're up 68% of the time. This is I would say, almost a stupidly simple system. I'll page back to the system. We use a number of models like this to inform and shape our market opinion. You know, when I say I'm a blended discretionary and quantitative trader, at the end of the day, I'm a discretionary trader. I'm making the decision to pull the trigger, making the decision to maybe scale back on some risk, but I have all of these advisors around me. These advisors do not watch CNBC, they do not read the Wall Street Journal, they don't speculate on what the FOMC may or may not do. What these advisors do, and they're all quantitative systems, and they're all parsing and processing different aspects of market behavior, and they give me a perspective, and then I kind of synthesize it and figure out what to do with it. And there's a couple more moving pieces in there, but that's the basics. It's a pretty tremendous ad right there. I think you just got your money's worth for the presentation there. Thinking about this two forces model, this is something I talk about a lot. It is the basic framework of how I think about markets. The idea is that certain trigger conditions can tilt the scales in favor of one condition prevailing over a future time window. If we understand the balance of these forces, we can understand market behavior. We can start to understand market behavior because there's certainly a high component of randomness. We can understand things about market psychology, market character. All of this is baked into the price behavior. It's also very, very important. And one of the things, excuse me, I'll take a drink. One of the things that separates my work and Waverly's work from a lot of the other stuff out there is most of the time everybody has an opinion, but the reality is most of the time markets are unpredictable. And we have to acknowledge that. We have to be humble about that, and we can't be afraid to say we don't know. You know, if you call and ask for an opinion on a market, many times the answer is going to be, we just don't know. We don't have an opinion. Let me dig into this research a little bit more because this is a product. You know, I have the book, I have the blog, I have the trading course, I have a podcast. Please check out my podcast, by the way. You could go to my blog, check out my podcast. It's a project that I started at the beginning of this year, and it's probably the creative project that I've done this year that I'm most jazzed about. It's a thing that probably has worked out better than I expected. So do check out the podcast. But I have all of this stuff that gives pieces and tools and techniques for understanding markets. It's kind of classroom stuff. I wouldn't say it's really theoretical. It's theoretical. However, the research is, the way I describe it is, it's the pointy end of the spear. It's where theory meets markets. It's where we actually take these lessons and see what happens when it meets the messy reality of markets. And we have a number of clients. You know, we serve clients who are institutional, professional money managers to beginning traders, and we cover the full range. And there's also a strong educational component to our work that, you know, this is not a black box. We're trying to help you. We're trying to help you, our clients, to first of all make some money. That's nice, to manage your risk, but also to work toward developing as professional traders. So the research is and you've seen a little bit of this already, it's a blended quantitative discretionary perspective on the problem of tactical trading. Yeah, the perspective on the problem of tactical trading. It seems very philosophical, right, and high-minded, but we really do need to put all of this stuff in context. And it's important to realize that we're just playing with probabilities is the best we can do here. We also have a lot of broad context on global assets, specific trading ideas, specific entry levels, stop levels, trade entry and trade management. We publish systems that are purely quantitative. And as I mentioned, one of those, you basically could run a very healthy CTA on one of the trend following systems we publish. If you did nothing but that, you over a large period of long enough time period, the returns have been very, very strong. We also publish a set of blended quant and discretionary trades, which we don't really encourage people to parrot our trades, to mirror our trades, if you will, but to use them as a departure point for your own work. However, they have had a very strong edge for the entire time we've been publishing. We do publish daily. We publish, except for take a day off on the weekend, we publish an extensive weekend report and then shorter daily updates depending on market conditions, but we publish every day. I want to dig into the tactical playbook. I'm going to walk you through, I don't want to take too much time, I'm going to walk you through, hit the highlights of the playbook. I don't think we really need to go through this. Let's just jump in. So the cover page gives this is what you would get from us early Monday morning at the beginning of the week, and you have we speak to traders working on different time frames, and one of our recurring messages is to clarify your time frame, to understand your time frame, and so we will talk about both long-term perspectives, big pictures, also very short-term flows. We have many traders who are day traders who never hold anything overnight. But on the front page, we give a very quick review of the week, very quick. If you only have 3 minutes to read the report, you can get the majority of what you need from the front page. Then we have a little, I would almost say, quasi-educational section where I will talk about some aspect of trading. So last week I wrote about the 4 categories of trades and toward building a vocabulary to speak about and understand trading ideas. And this is an example of one of our analytical pages. This is a page from our focus on U.S. equity indexes. And as I said, you'll see we cover everything, but our bread and butter, our focus really is on U.S. equities. It's sort of been a focus of mine as a trader. Here's an example of every day we give a short-term setup for intraday traders trading U.S. stock indexes, and these can certainly be adapted. We have traders who adapt these to other world indexes, but we're looking for trying to characterize the market environment. Is this going to be a day that is likely to reward aggressive application of risk? And I will tell you, coming into yesterday, we were looking for a trending session. It's something we had been telegraphing to our clients, and a lot of people thought that was unlikely before the FOMC, but which comes out Thursday. But we said, the quantitative setup is so strong that there's a high probability of a trend day, and if you see a break beyond a level, and we give specific levels, you want to aggressively pursue that trend. So that's an example of what we offer for intraday traders, for day traders, if you will. Rates and currencies, we cover the major currencies. We deal with these. We are also short-term focused here, but we're also very long-term focused. You can see in the bottom right-hand corner of your screen, I'm looking at the dollar index. I'm looking at a pattern that's formed over a year, and I'm considering what may happen in the dollar index over the next 6 to 8 weeks. So don't get the idea that technical analysis, this quantitative technical approach, is only short-term, because we really do cover the complete spectrum from intraday to 2 to 3 years to even longer time horizons. We cover major U.S. commodity futures, heavy focus on crude oil and gold. However, and that's a reflection of the market environment, but we look at softs, and we just had a great trade in cocoa, so we certainly do touch on all the major commodities. This is an example of some of the specific trades we publish. We will talk about these trades as they set up. I will walk you through what I'm seeing, walk you through specific entries, where we will put stops, and then each day we will put a stop and a target. Each day at the beginning of the trading session, comes out the night before, but you will see what our stop methodology, I don't need to use big words, you'll see where our stop is the next day, you'll see where our target is, and there will also be some discussion as the trade unfolds. And some of the feedback we've got from our clients is that this has been really very, very helpful toward developing their own trading strategies. Also, we publish quite a bit on individual stock setups, and that's specific patterns we're looking at and the types of patterns we're seeing. Here's an example of one of our quantitative systems, which I mentioned. We also publish a tremendous wealth of support material. So here is a view of the relative strength of global markets, relative strength of U.S. industries and sectors. Again, this is very helpful information for people trading U.S. stocks if you want to know where to focus. And we also look at these from an allocator's perspective, from a much longer term perspective. And we publish every day and on the weekends a set of quantitative screens, some of which are practically trading systems in themselves, some of which are a departure point for your own work, and these are things that everything we publish is something that I have used in my own trading, in some cases day trading, in some cases building portfolios for multi-week, multi-month swings. So it's all there. We would love to have you take a look at our research. As I said, our clients do cover the complete spectrum, from beginning developing traders to successful traders to professionals managing a lot of money. People use our research. We don't really think of ourselves as a trade service. We're not a newsletter. This is an institutional research product which we've been able to structure the firm so we're able to make it accessible to retail clients, basically. And some of our clients, you can use it for high-level idea generation. You can look at what we see in terms of broad markets. And by the way, I can take some questions. I'm kind of wrapping up here. Do we have time for questions, Ashton? I'll look at the chat, but if you have any questions, maybe type them in the chat, and I'll try to get to those, some of which I may not be able to answer in the time we have, but I have time if we have. Okay, Ashton says we have time. So if you have questions, put them in the chat box, and they'll get to me somehow, and I'll do my best to answer them. We also have a lot of traders who focus on the educational component of the research, so that's there too. We publish a number of research products. I've shown you the Tactical Playbook here, which is focused for short-term trades. I'll say short-term is inside of 2 months. We have a product that is targeted for the longer-term manager, perhaps for somebody managing their own retirement account, and then we publish an option-specific piece that looks at options and volatility on U.S. stocks and gives specific setups. I'd like to invite you to take a free trial of our work. You can see the email address here, info@waverlyadvisors.com. You also can go, like I said, Google me. You'll find all this information. Link is from my blog. You can also go to waverlyadvisors.com/trial and send us a note there, and we'll be in touch. Happy to get you started. I did mention my blog several times, and I would like you, if what I have said here resonates with you, is interesting, I would like to have you check out my blog and the podcast. Which, I can't tell you how excited I am about that. But my blog is adamhgrimes.com. adamhgrimes.com, and that automatically redirect to the blog. Link to Waverly Advisors is there, the link to the podcast is there, and I write a lot on, kind of split the difference. I have a number of very in-depth statistical analyses of markets, a lot of ways to think about tools and analyzing. Also, I've done a lot of writing and some video blogs on specific trade setups, so tools that you can go and use and apply, and which then, should you choose to become a client of our research, you will see these patterns applied in actual trading too. And then I've also written a lot on particularly recently, for the developing trader, for the trader who It's difficult to do here in 2 minutes, but just to help that trader be prepared for the challenges and for how long it may take to become successful and some of the things you can do to give yourself the best chance of success. So all that's there. Go check out my blog, adamhgrimes.com. And I do not see questions, so Ashton's going to get them to me. If you have questions, go ahead and type them in, and I will just watch the chat here and answer as they flow in. Yes, so question you're asking specifically, yes, can this be applied to Australian markets? We we have clients all over the world, and we have clients who apply these tools. I didn't really dig into, but we also focus on global stocks, and we do that at the index level. But we have clients in every country, and some of them trade U.S. markets, and some of them trade their own markets. There's a number of different ways to use the research, but yes, absolutely. These principles can be applied to any market, any time frame, and it's just a matter of adapting and figuring out how it works for your specific situation. And I hate dead air, so I will probably keep mindlessly rambling here while we wait for other questions. And also, if you have questions when these next few, it always feels so so important to get questions at the end of a presentation, but you don't have to. If you have questions after the presentation, or if you're watching this on replay, go to my blog, send me an email, send me a message. Many times questions become, if you have a question, somebody else probably does. The questions become motivation for blog posts, or sometimes I built entire podcast episodes around reader questions. So, please reach out, questions as you have them. Somebody asked about my views on the Fed rate. Okay, let me answer this a few different ways. The first answer is the true answer. I don't care. I don't know, and I don't care. Let me dig a little bit deeper. And Ashton, you can paste other questions if there are any. I think this is an aspect of the market. The market is focused on this. The financial media is focused on this, and I think it's silly and wrong and misleading, and frankly, it's a mistake. The idea that stocks have rallied because of quantitative easing is silly. The idea that stocks cannot rally in a rising rate environment is absolutely wrong. I can show you any number of places where, in the historical record, where the stocks have gone up while rates have gone up. That was difficult to say because it's 6 o'clock in the morning. I haven't slept yet. So, the rates can go up, stocks can go up. This is silly. However, I think what is happening, I think that the Fed and the IMF, I think a number of people, a number of institutions are misreading market psychology. It's the uncertainty that is hurting markets. My expectation would be, I think the Fed probably will not do anything this month, and I think that's probably based on a misguided idea that any action could hurt markets, where I think they could make a stupid rate increase, and just the resolution, the end of the uncertainty, the will they, won't they talk, just the end of that could be a catalyst to make markets go up. Now, this is also an interesting question, because what I just did is a good example of what I don't do in the research. We work very hard to separate opinion, politics. None of that bleeds into our research, and so much of what passes for investment research is just people giving their political opinion. We don't do any of that. What I've just told you, I don't think is really actionable. But in this, if you would like to start a trial of our research, I'll send you what I wrote over the weekend. And you can see that I've been reminding our clients for many, many weeks that this focus on the Fed is sorely misplaced, but we do have to respect the potential for that to shape markets psychologically. I have a question on what type of positive expectancy do you have in portfolios. We will, as part of the material, if you start a trial, part of the material we send you will include some of this information, some of this performance information. I'm sorry, I'm not dodging the questions. I'm not dodging the question. I just don't have the numbers in front of me. I don't want to say something that's not exactly accurate, and it is also 6 o'clock in the morning. Numbers are a little challenging. Do I use level 2s? No, absolutely not. I don't think there is any. If you're watching a dome or level 2, you have to realize that you're not even, the HFTs have processed and made trading decisions before you even see the data. It's done. The battle's over, and you've already lost. I don't think, and plus that information is so heavily filtered. In many markets, you're only seeing, everybody thinks they're watching every tick. You're not. You're not seeing every tick because your eyes couldn't handle that, and it's filtered in different ways. So I don't think there's any useful information there, and you know, I just don't think the scalping game makes sense for a human trader anymore. How do I set stops, ATR? Use a number of methodologies for setting stops, and again, this is something I've written about and talked about a lot. I think if you have no other way, like a good way to get started would be, for most swing trades, you probably look to set stops somewhere between 2.5 to 4 to 5 average true ranges away from price. There's a little bit of nuance that goes into that, and you know, like one of the things, if volatility is very compressed, we may want a wider stop, with just to respect the possibility that tomorrow's volatility could be very different than today's. So I don't use an ATR-based methodology. At the end of the day, it is a discretionary approach, but it is informed by average true range, informed by market structure. Any views on China and Australia? Yeah, China, in particular, mainland China, structurally is set up to take out the 2014 lows. This is a classic decline after a bubble, and we can show you, let's just mention a couple markets. NASDAQ index in the US in 2000, crude oil at the end of the financial crisis, and gold and silver in 2011. If you look structurally what happened in those markets, I'm actually writing a blog post on bubbles, is a classic buying climax, meltdown followed. You might argue the dollar index looks similar. I would argue against that. I don't think it does. And after these bubbles pop, we typically see volatile declines, as we've seen in China. It's not the end of the world, and you have to realize the Chinese stock market is not the Chinese economy. You know, there's a lot of fear mongering that we need to separate out from this. But we do see support for, I shouldn't use the word support, we do see evidence that suggests that China could trade under the 2014 lows, and then we would expect would be somewhere in that neighborhood for a protracted period of time, perhaps 3 to 5 years. Would be extremely unusual, not impossible. It would be extremely unusual for China to make a quick recovery back to the highs. That almost never happens. Who knows? We can talk more about that, but I think it's kind of the big picture. Keltner channels. Yeah, Keltner channels, again, go to my blog. I've written about this. Keltner channels, all we're doing, we have an average on the chart, and we're drawing bands around the chart. Bollinger Bands, which probably are a little bit more commonly used, use standard deviation of price. And there's some issues with that measure. The Keltner channels simply use an average range. So you're drawing, you know, say 2.5 average true ranges above and below an average, you draw a band. And this works similarly to Bollinger Bands. There's a little bit of difference. I like the behavior a little bit better. I find a slightly stronger quantitative edge in some contexts. So you know, we use Keltner channels. Again, you know, I'm not really blowing off the question, but I've written about it a lot. Some people use them. If you just Google my name and Keltner channels, you'll find some of what I've written. And that is all the questions. So I'm going to hand back to Ashton here, if I can figure out how to do it. Got it.
So I just wanted to thank Adam very much for giving us his time tonight. As many of you are probably aware, it was 5 a.m. over in New York, but Adam is an early riser and is very passionate about the markets. And I think the Waverly research does offer a real insight into the US markets and takes a lot of the work out of having to cover international and US markets. I think what people are often looking for is a time solution, and Adam Grimes and Waverly Advisors do offer that time solution for you so that you can be trading with a real edge in the markets, covering I guess markets which are outside of Australia. Australians, and I've found this in many countries around the world, that most domestic investors are relatively married to their own stock exchange because that's what they understand. But when you're trading with an edge, a technical edge, a quantitative edge, then a report like this can really add some value to you. So we do have a special offer this evening. As I mentioned, if you open an account for new clients with $1,000 Australian or equivalent in the next 7 days, or if you are one of our existing clients who have not yet traded the US equity CFDs with FP Markets, we will be offering a month of free research from Waverly Advisors, which is their tactical playbook with tradable ideas and good coverage of the US markets. You will also receive from FP Markets 400 Aussie dollars in US markets brokerage to get you underway. And in terms of the data feeds, we do offer free data feeds to all our international markets, including the US markets, with a 20-minute delay. For those people who do go onto our website and look to open an account, I just want to make a note that at the bottom of your application form, we need to have this area filled out which says where you heard about us. And if you can just write in there the US Markets webinar, that's going to identify for us that we can give you the 400 Aussie dollars in US brokerage. As well as the free month of Waverly Advisors research. So just down the bottom there, this is on our website. There's a button to open an account, and as you get into filling out your basic details, you can put at the bottom where it says who referred you to us, US Markets webinar. We'd like to thank you for listening this evening. Hopefully you've got a lot out of listening to Adam Grimes. Also understand that he does have a blog as well as the Waverly Advisors research. His book also makes excellent reading. I've certainly read it myself and have been using the research quite successfully over many years. The webinar will be on our website, www.fpmarkets.com.au. And if you do have any additional questions, feel free to write the questions in the text box. We will envisage touching base with many of you who have logged in this evening for the webinar to answer those questions and to give you any additional information that you may require, whether it's to do with Waverly Advisors or to do with ourselves in what we have to offer or opening an account. And I did just want to put at the bottom there my email, a.mags@fpmarkets.com.au. This is on the next slide, and anybody who's in the Sydney area, we always welcome people coming in to meet with us. We're on level 5 Exchange House next door to the Australian Stock Exchange at 10 Bridge Street in Sydney. My direct line, my name is Ashton, if I didn't introduce myself, I believe at the beginning. My number is 02-8252-6825. That's my direct line. And we also have the toll-free number 1300-376-233. Email address is a.mags@fpmarkets.com.au. So Thank you very much, everybody, for logging in for this evening's webinar. And as I said, feel free to shoot through any questions to ourselves or to Waverly Advisors. And this presentation will be going up on our website around lunchtime tomorrow. Thanks once again to Adam Grimes and to Waverly Advisors, and good night.